Good morning from London. I'm Guy Johnson alongside Kriti Gupta. Anna is off today. We're an hour away from the opening trade. So what do you need to know? Polls are opening in the UK as voting gets underway in today's general election. Pressure is mounting on Joe Biden to step aside. VP Kamala Harris emerges as the surprise alternative to replace him. And speaking exclusively to Bloomberg, the Ukrainian President Volodymyr Zelensky challenges Donald Trump to reveal his plan to end the war, Kriti.
A quick check on these markets here. As of course, the markets are closed over in the States. That does mean light liquidity, light volume. Euro Stoxx 50 futures virtually unchanged at the moment as well. The 10-year at 4.35. This follows a 10 basis point move in yesterday's session. Euro dollar 107.90. Brent crude slightly lower today, taking a bit of a breather just shy of $87 a barrel. The countdown to the opening trade starts right now.
I'm here to tell you today, President Joe Biden is in it to win it. And all of us said we pledged our support to him because the stakes could not be higher.
None of us are denying Thursday night was a bad performance. It was a bad hit, if you will, on that. But it doesn't impact what I believe. He's delivering.
The president was very clear that he is in this to win this. And the president is our nominee. The president is our party leader. And the president has told us, and he was very clear back there, that he is in this to win this.
Various Democratic governors outside the Oval Office yesterday giving their backing to Biden. It is Thursday, the 4th of July. It is Independence Day in the United States. A moment maybe for America to pause and consider what happens next. Joe Biden's future absolutely front and centre, and the market is watching this trade very, very carefully. The bear steepener has been put on over the last couple of days as the market prices in a Trump presidency. Could a change at the top of the Democratic ticket alter the mathematics on that one, Kriti?
It's tricky because we're seeing all this polling data. We're seeing this idea that Kamala Harris is potentially seen as a front runner to replace him if he does indeed step aside. But it is still young. We still have a couple of days for this to all shake out here. We've got a debate tomorrow in particular, an interview. Yes, I'm so sorry. An interview tomorrow with George Stephanopoulos on ABC. So this is prime time in the States tomorrow night. The polling data in the fallout of that could be the make or break moment for Biden and his campaign.
The mathematics, the arithmetic around the story is really interesting. What happens to the money?
Yeah.
What happens to the delegates? All of this kind of up in the air at the moment. Nobody's really got a clear handle on exactly how the process will work. And I think that's also complicating matters here at the moment. But from a market point of view, the Trump trade has been put on. Any change at the top of the Democratic ticket, I think, could potentially have an impact on that trade.
It could, but I would also argue that perhaps the Trump trade has been in play for a very long time. This is not the same playbook that we had in 2016 or 2020, where you basically hedge, buy big into American assets, simply because the economic agenda this time around is so different than it was the last time around. The tariffs, for example, that he campaigned on are already still in place. The oil story is already still in place. We still don't have clarity on what that looks like outside of the deficit story, which, to your point, is showing up in the bond market.
Yeah, that's really where it's showing up. That's that long-term bond yield story.
Yeah.
As we see that sort of bear steepening and those longer duration bonds moving higher in anticipation, potentially, of more spending and more inflation and less immigration and all of those factors being priced in.
And that all factors into, if you're going to kind of Trump-proof an economy, do you then have to Trump-proof institutions? And that's a conversation we had, our very own Anne-Marie Hordern in Kyiv, actually, with none other than President Volodymyr Zelensky, really having this conversation and kind of holding Trump to account. His comments in the debate in particular, take a listen to what he had to say.
If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this.
So Volodymyr Zelensky trying to there kind of make sure that his country is in safe hands, that the continued aid from the states is something they can count upon. We heard from NATO yesterday as well, the U.S. ambassador to NATO. They are centralizing operations to fight that threat, but not only in the States and from Trump, but from the far right here in Europe.
Absolutely. So there's two kind of themes coming together here, I think, which is really interesting. Zelensky's got to look at what is happening in Washington, D.C. and understand what the implications of what we've just been discussing surrounding the Democratic ticket could mean for his country and what a Trump presidency could mean as well. But look at what is happening in Europe as well. The move right in Europe could have potential implications as well for the conflict in Ukraine, and also the ability of Europe to rearm itself and the spending that potentially could go through with that as well. It was really interesting listening to Marine Le Pen on French television last night. She is clearly really ticked off about what is happening. 223 candidates have withdrawn from these triangular races, these three-way contests that are happening in the various constituencies around France. That's going to make her path to power significantly more difficult, and she is clearly annoyed that the majority is maybe getting harder and harder to obtain.
What collaboration, by the way, from the centrists and the far left. I don't think I've ever seen anything like that. To me, the question is, we'll bring it right back to the markets. How do the markets play this? And I've been talking about this all week. Euro-dollar, to me, going into the next 24 hours, is the pair to watch. One, because the French impact on the euro, but then also the U.S. data over in the States and what that means to that dollar bid.
We've got a French auction coming up a little bit later on today. That'll be an interesting tell, maybe also on what is happening here. French bonds, are they permanently wider now against Germany? Do they resemble more, you could argue, BTPs?
There's a lot to digest. There's a lot of geopolitics, and the problem is nobody actually knows how to play it. So we're going to bring the one person in the room who just might have an idea. John Authers from Bloomberg Opinion joins us this morning. John,
no pressure.
No pressure at all. Give us all the answers. Look, I sat next to you for years, and I feel like you're an encyclopedia on all of this. So I think you won't disagree when I say the Trump playbook, the Marine Le Pen playbook, even, is not the same as it has been in 2016, 2017. How do you trade it?
With difficulty. I think the key point you should make about what happened yesterday in the US is that some slightly indicative of getting worse initial claims data and some not particularly good services ISM were more than enough to counteract the Trump trade. Amid the obvious growing signs of political crisis, for the Democrats, you actually saw the bear steepener unwind quite a bit because people are more concerned ultimately about the economy and the possibility of rate rises in the next 6 months than they are about Trump. I think that it does make sense to. I think there plainly is something going on where, as people really begin to confront the likelihood that Trump gets in again for Trump 2.0. That's not going to be good for the deficit, and that even though inflation is one of the big reasons that's helping him, he's not proposing to do anything that will ameliorate inflation and proposing to do a lot that will make it worse.
John, let's just talk a little bit about the ISM data, because I looked at it, went through the numbers, trying to figure out exactly what it meant. The top line number, that's a big miss. The prices paid component, really still quite strong at 56. Talk to me a little bit about what the data are telling you in aggregate at the moment, because it feels increasingly stagflationary. It doesn't feel... It feels... the inflation remains sticky, but the growth is beginning to wane. And I'm wondering how you think the market should handle that, how the Fed should ultimately handle that. The messaging we're getting from the Fed is we want to be cautious on the inflation front. And is that caution there for a good reason?
I think I've tended to be a hawk on inflation throughout the last few years, and I'll continue that. I think if there is one thing they really badly want not to do, it's let the inflation genie out of the bottle again, and you do have to be very careful to make sure that inflation expectations are contained. I find the Michigan data from last week, the consumer sentiment, the mean expectation for inflation is going through the roof, like 5% inflation is the...
Is that unanchored?
It looks to me as though it's certainly coming unanchored, that there is a large proportion of the population who are expecting very significant inflation. They are expecting an outright failure by the Fed to deal with this. In those circumstances, I don't think they have much choice but to be very cautious and run the risk that something, that the economy slows down more than they would like.
So let's bring it right back to the markets then, because we had this data dump in the last 24 hours. We have the geopolitics overhanging all of us. And then we've got payrolls tomorrow. Does it even matter that we're getting this data print tomorrow when it comes to pricing? Again, I'm obsessed with the Eurodollar, but anywhere else in the markets, does tomorrow's data point matter?
Yes, I think it does matter. I mean, it certainly matters less than it has done at times, and CPI next week will matter more.
Yeah.
But if you do get if we finally validate, or is perceived to validate, that yes, the US labour market is finally unambiguously weakening, the Fed has gone to great lengths to say that that matters a lot, and it does increase the chances of rate cuts. It's no influence at all on politics. That is just. It may be the reason that Biden is in as much trouble as he is initially, but there's no chance of anything with regard to the economy really changing the politics.
John, great to see you. Thanks for stopping by to see us. Nice to see you on this side of the Atlantic. John Althus from Bloomberg Opinion, joining us on Independence Day. Let's tell you what we've got coming up on the show a little bit later on. Nancy Curtin from Alti Tiedemann is going to be joining us. Blue Bay's Mark Dowding is going to join us on the markets. Plus, we're going to look ahead to the implications of the French elections. We are going to speak to the former ECB chief economist, Peter Praet. Barclays head of European equity strategy, Emmanuel Cao, is also going to be joining us. And Roxane Varza, director of Station F. Now, Station F is a startup campus that was launched by Emmanuel Macron. We'll get her take on what the end of the Macron era, Critty, might ultimately mean.
Yeah, we have a ton of great guests to your point. We've got plenty of data as well to watch. I'm going to walk you through what you want to look on today's daybook as well. ECB's June meeting minutes. Do we start to see some signs of division there as well? Not to mention my personal obsession, the fact that those EU tariffs on the EV space in China, they do kick in today. Now, Danny Lee, a reporter out of Asia, I should say, saying that, look, this is just kind of a money-changing hands thing. There's still negotiations going on in the background. That's going to be something that we keep an eye on. Of course, it is the UK general election. We'll have full coverage for you later today as well. And it is U.S. markets closed. So when it comes to that low liquidity, low volatility narrative, it feels like that's kind of today's story for the markets.
The interesting thing will be tomorrow to see whether that carries on. Do a lot of people take the day off? If they do take the day off, what impact does the payroll number have if it causes a surprise? So I think that's going to be fascinating to see how tomorrow we kind of, A, position for the French election, and B, digest that payroll number coming out of the United States. And the U.S. political story, I think, is going to be really interesting. That ABC interview was going to air on Sunday. It's now going to air on Friday. So I think that's going to be in the mix as well on that day, too.
The need to get clarity on these polling numbers and the need for the Democrats to kind of make a call, whichever way it is significant. And I should put this in the context that we're talking about dozens of lawmakers starting to push on Biden, but this is in a room of 435 members of Congress to begin with. So, yes, the pressure is ramping up. Is this enough to really change the ticket this close to the election? That's going to be something we watch in the States. We also, of course, have election on our mind right here in the UK as well. Voters across the UK casting their ballots in the general election today. You want to stick with us for a special program when polls close at 10 p.m. London time. That, of course, with Francine Lacqua right here on Bloomberg Television.
So plenty of politics. What else do you need to know this morning? Let's start off in the Middle East. CNN is reporting that Israel and Hamas appear to be on the brink of a framework agreement for a ceasefire and a hostage release deal. Prime Minister Benjamin Netanyahu's office said it had received the latest response from Hamas on a proposed hostage ceasefire agreement that could end almost 9 months of fighting in the Gaza Strip. Chinese President Xi Jinping and his Russian counterpart Vladimir Putin have said the relations between their two countries are, quote, at their best in history. The two leaders met for the second time in less than 2 months yesterday on the sidelines of a security summit which was taking place in Kazakhstan. It comes, of course, as frustration grows amongst many Western governments over the perceived Chinese support for Moscow's war efforts. We heard about that yesterday. And JP Morgan's chief global market strategist, Marko Kolanovic, is leaving after 19 years at the bank. An internal memo obtained by Bloomberg says he's leaving to explore other opportunities. Kolanovic had a disastrous 2-year stretch of calls on the US stock market, staying bullish as the S&P tumbled in 2022, then turning bearish as the market bottomed and then rebounded. Is that... I saw this story yesterday and I thought that's the top of the market. When the last bear leaves the building, is that the time that the equity market rolls over?
I don't know. We had Mike Wilson kind of defecting to the bullish side as well.
Yeah, but he wasn't the last bear.
He wasn't the last bear.
is the last bear.
Is he changing his market call, or is he simply switching gigs?
Well, okay, so he's leaving the shop that he's worked at for a very long time.
Yeah.
In the past, we've seen incidences where this has happened, and it's like building the tallest building. You when that moment happens, it's like you know that disaster is not too far away, and you wonder whether this equity market that has had such a great run, the last bear, gone.
Well, can we just take a moment for this equity market, though? Kolonovich aside, the fact that we're still seeing a rally across the tech sector, across the indexes, something that we're still waiting to spill over. I think there was an expectation. I think the TOPEX, for example, hitting a record over in Japan as well.
They've had a great run.
They have had a great run.
Where's the momentum? What keeps them going? Actually, in many ways, the big surprise would be, if you look at the calls of many Wall Street strategists, the big surprise would actually be that the equity market keeps going from this point.
All right, that's something we're going to be discussing throughout the show. Where do you put your money? Where do you put your expectations? Coming up on the program, Ukrainian President Vladimir Zelensky challenging Donald Trump to reveal his plans for ending the war with Russia. We'll get more from our exclusive interview later in the show. Plus, far-right leader Marine Le Pen lashing out at rivals for joining forces to block her National Rally Party from getting an absolute majority. We're live in Paris for the latest ahead of Sunday's vote. But up next, we're going to look ahead to tomorrow's U.S. jobs report. Nancy Curtin of AITI Tiedemann Global joins us this morning. If you have any questions of your own for our guests, please send them to us on IB plus BBTV Go. This is Bloomberg.
Thursday, the 4th of July, 40 minutes to the market open. Futures are pointing higher. It is going to be a low-volume session. The United States is out. It's Independence Day. It feels, therefore, appropriate that we should talk more about America with some Americans. Minutes from June's FOMC meeting showed Fed policymakers a little divided on how long to keep rates elevated. It comes as a big pullback in U.S. services data yesterday reinforced the case for rate cuts. Or did it? Nancy Curtin, CIO of AITI Tiedemann Global, joins us now. Good morning. Happy Independence Day.
Happy 4th of July.
Yeah.
Absolutely.
Great to see you on this side of the Atlantic. I don't know whether to start with politics or with the data. Should I be putting the Trump trade on? Is it too early to talk US politics? Should I still be focusing on the data? Maybe that's the best way of framing it.
Okay, politics, I think it's a little too early to tell. Of course, the drumbeat is going in the Democratic Party, and we'll have to see what happens with donors and the insiders in terms of what happens with Biden. We just don't know. Is it an open convention? Is it Kamala Harris? But I think it's too early to tell. But look, the bond markets have moved here because Trump, if he were to get in, would extend the tax cuts. That's another $4 trillion to the deficit, not to mention raising tariffs, and that could have implications for low-end consumers. So, there are things to be concerned about, but I think it's too early to tell.
But what might that look like, though? If let's say we're getting closer to the election, the economic agenda from Trump to Biden this time around looks very different than last time around. So does the last term's playbook even apply here?
Well, I think the tax cuts apply because he's already said that he's going to extend them. But let's face it, neither president is particularly fiscally prudent here. And so I think what we have to watch is that the long end of the bond market begins to focus on the tsunami of debt supply ahead and the implications for funding that. And so we've been cautious on the long end of the bond market, thinking the yield curve would steepen here. Let's see what happens. But that is, I think, one of the implications.
I'm having deja vu. Isn't this the exact conversation we're having about the French elections as well? That either candidate is...
Everybody's going to spend money.
It's the deficit.
Yeah. But here's the difference, okay? In France, let's call it fiscal populism. They're both talking about spending money, but they're spending money on things that I don't think really add to the productive capacity of the economy. That's very, very different. The Inflation Reduction Act and the CHIPS Act, which are actually investment in infrastructure.
Yeah.
That adds to the competitiveness of the United States. It's investment spending. That's very different than spending on pensions.
So I should treat U.S. deficits as being a positive and European deficits as being a negative.
Well, I didn't say that, but broadly, I think when the deficits are geared towards investment spend and infrastructure spend, that is better spending than just spending
It definitely
money.
feels like a 4th of July Independence Day kind of conversation. We're different. We've left you guys. We've
Are you feeling okay about that?
Yeah.
Is that digestible for you today?
Yeah, I think so. I think we're okay with it. So what is the data telling us? Let's get back to the data and kind of figure that out, because we were debating the ISM numbers a little bit earlier on, trying to figure out what the picture here is. The headline number looks weak. So it feels like the service sector finally is beginning to slow down a little bit. But if you look below the hood, what am I seeing? I'm seeing a lot of inflation still. Is the fear here actually stagflation? I hear what you're saying about the productive capacity and the US economy looking in a better shape, but actually is the danger that we stick with this inflation and we slow down on growth?
Look, I think the services data tends to be very volatile, so I wouldn't put too much stock in one month. What I would say is there's some cracks, right? So we know that. Mid to upper end consumers in the United States, which is 70% of GDP, look fine to me, right? The household wealth is the highest since the 1950s. Personal income numbers have come in quite strongly. Even the GDP number, consumer spending, was 3.3% annualized. Okay, so I think that cohort's looking pretty good. The cracks in the system is low-income consumers, is in the housing, manufacturing sector, the banks, obviously regional banks. So these are the ones that have been more impacted by the restrictive monetary policy, and there are some cracks in the system. And remember, the Fed has a dual mandate: price stability and maximum employment. So the Fed will be watching. If any of these cracks have implications for the labor market, we'll probably get a cut.
It feels like when people make that argument about the cracks as well, they point specifically to the data of the households re-leveraging in the wake of the stimulus story. And if you talk about it from a big picture, broader perspective, stimulus is running out. Money markets, the cash that's on the sidelines is starting to run out. To your point, is re-leveraging a problem, though, when historically, I'm not talking about the public deficits in people's personal finances, is that a problem when Americans are known globally for not exactly being the best savers?
We do like to spend money. No, I don't think it's a problem because household debt is the lowest in 23 years. So here's this bifurcated economy. Low-income consumers, savings depleted, delinquencies are rising, but they count for 12% of consumer spending. 88% of consumer spending is in mid to high income, and they seem to be doing just fine, and I think continue to spend on services.
If the stock market rolls over, are they still going to be fine?
Well, part of that household wealth is house prices, and part is the equity market, and part is you can make money on deposits. So you're right. The equity market is a
Do you think the equity market's going to roll over anytime soon? Marko Kolanovic has left J.P. Morgan. That's got to be a signal maybe that we're getting toppy.
A little embarrassed there. Look, I think what we have to watch is the second quarter earnings, right? We're going to kick off in mid-July. And unlike the first quarter where the bar was pretty low, we leapt over it in terms of expectations, the second quarter, the bar is much higher. Technology is supposed to deliver 30% earnings growth. The rest of the market, 5%, 9% overall. That's a higher hurdle. Now, if we get there, that'll be positive. So I think we have to keep an eye near term on earnings.
All right, I'm putting you on the spot. 15 seconds. Do you buy into the U.S. index right now going into the election in the back half of this year?
Okay, so what we think is you move to the parts of the market that are less highly valued, where we see earnings accelerating and valuations more attractive. So it's a bifurcated market. Yes, there are opportunities.
Okay, Nancy Curtin, towing the diplomatic line, CIO of Alti Tiedemann Global. We thank you so much for joining the program. We're going to take that conversation about the markets and the geopolitics and now bring it back to Europe. Coming up, you do not want to miss our interview with former ECB chief economist Peter Prett on everything that's going on in the European economy, the read-through perhaps from what you're seeing over in France as well, not to mention the deficit story we just talked about in the States and how it applies to the continent. That conversation next. This is Bloomberg.
Don't see any kind of strong easing of the spread, of the French spread. That is, yes, we observe slight easing, but we don't believe to have the spread coming back to the level observed a few weeks ago, before the snap election and the result of the European election. and we just see the risk of having a kind of drift or moderate spread at best until at least 27.
Christophe Bouchier, the CIO of ABN AMRO, talking to us a little bit earlier on French bond spreads and the implications of the snap election, the second round coming up this weekend. Let's get a central banker's perspective on what we are seeing in Europe right now. Peter Praet, former ECB chief economist, joins us now from Brussels. Peter, always a pleasure. Put your central bank hat back on again for a moment, if you would. How do you think central bankers are viewing the political instability that we are seeing in France and elsewhere in Europe right now?
I think it's a big worry. When you look at, the data and central bankers, ECB, governing council members can be rather satisfied because the developments correspond to the base scenario, essentially, in terms of growth. It's not fantastic, but still, it's in the baseline. Inflation is coming down, and it's also according to the base scenario. So there are reasons for satisfaction, and that has been communicated, in Sintra a few days ago. Now, below the surface, there is a lot of worry, and I think we are in a situation of testing what we call fiscal dominance for central bankers. You know that the fiscal positions of a number of countries is not very good. And there are a lot of requests, from voters and from the populations, indeed, to spend.
Oh, I think we may have lost Peter there for a moment. We'll come back to him once he has unfrozen and starts moving again. It's that fiscal dominance story. It's the fact that voters are talking about the need to spend more money. How do central bankers respond to that? How should Christine Lagarde be responding to this? There's been a debate between Germany and France as to whether or not the ECB should play a role in managing the spreads, OATs over bunds, managing that French bond story. Should they be using reinvestments maybe to support the OAT market right now?
And remember, this is already coming with a lot of pushback. Even the concept of potential intervention, however they choose to do it from the ECB, Christian Lindner over in Germany already saying that is a no-go.
Exactly.
We're not touching that at all. Let's bring Peter back into the conversation here. I think we've established the line. Peter, let me put that question to you. What does that bar for intervention from the ECB actually look like in your view?
I think that's the right question. The bar should be set quite high. And I think, that you need market discipline. And you need also the discipline of the peers, because when the spreads go up in France, there are spillovers on other countries and they don't like it. So I think it's important of the disciplining process to let the bond spreads, go up, and market discipline and peer discipline, play their role. So if the ECB puts the bar too low in terms of interventions, markets in a way would love it because they say there is a backstop from the central bank. But I think that would be a mistake. So I think the central bank should be, very careful in the communication. I think when Christine Lagarde communicates, that price stability and financial stability are closely related, I think it's totally true. But at the same time, we should also say that markets should not expect, interventions of the central bank, so easily. So they should keep a lot of ambiguity, at least for the time being. And I think they're rather careful, but I think the markets are a little bit too expecting probably a little bit too much from central bankers at this stage. So I think they should be tough. It's a test of fiscal dominance, and what we have seen in the UK, for example, the central bank I think won in the end, but that was very very tough actually, and you cannot ex ante promise too much, that, if things go really wrong, you're going to intervene. So the bar must be very high. I mean, that's my position.
So Peter, you talk about the fiscal ability and fiscal prudence. We're talking about it from a deficit perspective in France, but we also talk quite often about the fiscal expenditure in Spain and Italy, this periphery, even arguably Greece, the periphery outperforming the core. How long does that sustain, in your view? Is that something to be concerned about, that the strength is coming from smaller economies rather than the larger ones?
Well, I think it's a very heterogeneous situation. I think what we see, Italy has huge challenges. I don't think you can compare really the fundamentals between Spain and Italy. I think Italy remains very challenging, but must recognize, that Italy is benefiting a lot from transfers, from the European Union, as you know, that's one thing. But the structural productivity problems in Italy still remain. I mean, you cannot correct that very quickly. And so, given also the lack of fiscal space, and that remains difficult. So I think you have to look at the country specifically. I think Spain is quite different from Italy, although the Italian situation, of course, has been much better. But the worry, of central bankers,
Does France look more like Italy now, in terms of how we should perceive it from a market point of view?
Well, I think markets are quite, satisfied by a sort of hung parliament or, a sort of government not taking a lot of decisions up to the presidential election. So this is a sort of small window, I think, of trust that you have in the market, regain trust in the markets, because, people would love, to get, 70 basis points extra spread compared to the bond without tail risks, with the expectation that if really things go wrong, the central banks will intervene. I mean, this sort of moral hazard is, I would say, unacceptable. And I personally think that the markets are a bit too optimistic about the situation and the transition to the presidential elections in 1 year. Now, we will see, of course, but next week a little bit what is the situation. But I think the markets in general are too lenient.
We spoke to Jean-Claude the other day, Jean-Claude Trichet, and he was suggesting maybe it wouldn't be beyond the realm of possibility to see Christine Lagarde step into French politics once again. Is that something that you think could be likely? What impact do you think that would have on policymaking in Frankfurt? Is this a shift that we would welcome or not welcome?
Not welcome. I think Christine Lagarde she said it. I mean, she is in Frankfurt. She has to do her job. The job is not finished, so she has to do it to the end. So I think she's right. I'm not sure to have a technical figure in that sort of environment, where populism is quite, strong, populist pressures, to have a sort of technocratic image for the new government. So personally, I think the situation is quite different from the situation you had in Italy with Mario Draghi. So I think Christine Lagarde should finish the job, as she said, rightfully. First point. The second point is I don't think in the present environment of strong populism in France that putting someone with a technocratic image, a central bank coming in, I don't think that would be a good idea.
Okay, so that's the politics in Europe. Let's talk about the politics in the States in particular. When we're talking then about the read-through from potential tariff policy, regardless of who is in the office, Peter, where are you looking for that read-through? How quickly could it manifest?
I think it's, there are a lot of worries, domestic politics, international politics, and the US in particular. I think it's extremely serious in this sort of new environment, especially if there is a change of president. In that new environment, you need to be strong, actually, and you have to be cohesive. And in sort of transactional, sort of geopolitical environment, I think, it's a question of bargaining power. And what we see in Europe goes in the other direction. And so I think markets have understood that, and they look very much about, when you look at stock markets, they know their potentials in Europe, but they prefer to have, the stability of of the strength, I would say, of the US. So I think this is not a very good environment, which I think, again, it will be in the report of Mario Draghi. But as you know, this report of Mario Draghi was foreseen in June. Then people said it would be in July. Now people talk about September. It is clear that in that report, what you will find is that Europe need to be cohesive, need to be strong, and need to have some European fiscal capacity and strong industrial policy. All these things will likely be in. Now, what you see in the reality, it's exactly the opposite that you see in terms of political forces. It's more divisive, more heterogeneous. And even if you look at the extreme right is, except maybe on some aspects of immigration, but the extreme right is extremely divided on these major, issues, geopolitical and economic issues.
Well, speaking of that divide, a way to perhaps bridge that, being put forth by several politicians on the continent, has been this capital markets union. If you start to see these cross-border transactions or this banking consolidation, we've heard time and time again. But, Peter, I'm curious about the timing of all this. Guy and Anna love to remind me that this has been a conversation been happening for decades in the works. Talk to us about visibility here. What are the odds this actually happens in the near future? Put a time frame on it.
Yes, I think, again, very good point you make. I mean, there are two approaches, of course, to the capital market union. The one is bottom-up, the other is top-down. The bottom-up with very technical measures, for example, the withholding tax regime, for cross-border flows of coupons, on investment. I mean, that will continue, I think, from the Commission. So I think this roadmap will continue. But a more top-down approach, indeed, I agree with your point, is probably much more difficult. I think for the capital market union discussion, I think basically it's the economic fundamentals that count. It's not only all these technical measures. It's really the business environment that you have for firms, the internal market for goods, services. All these things play a big role. So I think there are a number of technical barriers and they should be tackled, and some of them will continue to be tackled. But I think it's basically the environment, the business environment, that will count for, for stock market to reallocate savings, to the most performing investment. I mean, for that you need a regulatory and tax environment which is friendly. And what you see today is more divisive and with a lot of uncertainties, of course. Especially when you look at France, for example, what the Macron government has done in the recent years has been quite business friendly, and you see results in terms of the development of Paris as a stock marketplace, investment place. You see that very much as a result of that sort of policy. Now, the potential reversal of that sort of policy would be very damaging, and so you cannot blame the lack of capital market union. I think governments themselves should look, why savings, flowing to the United States and other countries and not staying in Europe. I mean, basically investment opportunities first. Second, of course, I fully agree that a number of barriers that should be, levied, but that should go dismantled. But but I think the main question is really the business environment.
Peter, always a pleasure. Thank you, sir. When you're in London, come and join us around the desk. It would be a great pleasure to host you here at Bloomberg. Peter Pret, the former chief economist over at the ECB. Coming up, Continental lowering its autos guidance in Europe, but China could still prop up this sector. We're going to talk about what is happening with the autos in stocks to watch. That is coming up. I'm going to leave you with a live shot in Islington. From Islington, London, the polling stations are open in the United Kingdom. This is Bloomberg.
We're about 13 minutes away from the opening trades across Europe. You are seeing futures pointed higher by about 0.2% in Euro Stoxx 50 and the FTSE 100. You are also seeing some green on screen in some of the other indexes as well. But it feels like the story on both sides of the Atlantic is really the politics. You, of course, have the UK election. We will have full coverage for that later in this region. We'll also have the French election this weekend, plus the drama over in the States as well. How do you trade it? Let's bring in an expert here. Marcus Live executive editor Mark Cudmore joins us this morning. Mark, the popularity around the steepener trade right now, betting on a potential Trump 2.0, seems to be the go-to way to play these headlines. How long does it last?
Yeah, that's a great point, Critty. I think that people are defaulting that to the moment. I'm slightly unsure in that one in terms of that it works because of the current economic backdrop as well. I could see a scenario where Trump falls in the polls and yet we don't see a massive unwinding in that steepener trade. What I mean is that I think people the election or the debate last week and the folks in the election is helping people realize that all candidates are essentially fiscally positive, and therefore that means probably higher long-end yields. At the same time, we're seeing some softness in front-end growth. So the economic backdrop is kind of helping that narrative of a little bit of steepening. Yes, people are talking about it being fueled by the politics, but I think it's a little bit of the narrative fitting the data at the moment.
Mark, I read your piece on Bitcoin yesterday. Double top. Looks like that's the story on the chart as well. Dismal second half potentially in prospect. Bitcoin in some ways is a proxy trade for tech. Like in some ways, not completely. If Bitcoin has a dismal second half, does tech have a dismal second half?
Yeah, I'm really struggling with this one, guys. So I should point out that, first of all, this is based on a technical signal that's worked perfectly since December 2021. I want to emphasize it's only about technicals here. There's no fundamental reason here. There rarely is in Bitcoin anyway. Technicals tend to be the main guide there. But if these technicals work, they imply that Bitcoin does have a dismal second half, as you say. Now, one of the things is what are the correlations to the rest of the economy? Generally, we've seen Bitcoin collapse in a risk-off scenario. It has showed the greatest kind of link to those kind of tech stocks. However, I think that, you know, the crypto economy is not overly linked. We've seen this when we've seen some really dramatic moves in both directions, that the spillover hasn't been as big as many of us expected, including myself. I thought before that if you saw a complete kind of fallout in crypto, that would spill over to retail traders bailing out of other stocks, and that would be a wider route. We've not yet seen that dynamic. So I think there's potentially a scenario here where crypto can sell off without it being a risk for the broader economy, but I am very open-minded to maybe it's an early warning sign.
Is the Friday trade tomorrow positioning around payrolls or preparing for the French election?
I think that the payrolls really matters because that ISM data, I think we really care. I can see us moving beyond payrolls extremely quickly. Everyone's watching that unemployment print. What I'm slightly worried about is when we're talking about that unemployment print, do we get a little bit of a stagflationary impulse, i.e. we still get high wages and yet we get signs of job market softness? Because that is what the ISM data was yesterday. Still high prices paid, and yet the economy seems to be slowing down quite markedly. So I think that's the real focus in the short term. But as soon as non-farm payroll is out of the way, then we start focusing on French election, and that will matter into next week, even more than the last round of the election.
All right, Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you so much for joining us this morning. You can get more from him and the team. All you got to type in is MLIVGO on your Bloomberg terminal. Let's go from the macro to the micro and get your stocks to watch with Joe Easton from our equities team. Joe?
Morning, Critty. So we've got some more negative news out from Ericsson today. The company announcing another impairment related to a deal they did a couple of years ago for a communication services business called Vonage. Now it's the second impairment in just around 8 months for Ericsson on this business. The impairment today, around $1 billion. They're writing off the value of this asset following a $2 billion write-down around 6 months ago as well. Now, they bought this business for around $6 billion, but they're saying today that the company has seen a deterioration in its market outlook. So they are downgrading the value of that company. And as we can see, a lot of sales already on this company, given the decline in the share price over the past few years, partly due to the infrastructure slowdown, but also concerns around this business. It's not being taken well this morning. Then we're also going to move over and look at Continental. The company last night, the tyre maker, an auto parts firm, held a conference call with analysts, and it is overall looking quite positive because although the tyre business has seen declines in volumes in Europe, slightly offset by China, the automotive business, this is doing brakes and also safety controls, that's doing really well. And Jefferies today saying that they will upgrade their earnings forecast for that part of the business, and it will provide much needed relief to the market, according to analysts over there. It has been an underperformer in terms of the broader autos index. The white line there, we can see Continental lagging that due to the tyre issues, but this automotive positivity could help narrow that gap this morning. Finally, we've got a bit of breaking news over in healthcare. Roche is halting a lung cancer drug trial. This broke just around half an hour ago on the terminal. The company says that it did not meet the primary endpoints, the keywords that we look for in those statements. It showed reduced efficacy in a big trial, and they'll reevaluate whether they're going to continue with this drug. It was a combination of a few different drugs with chemotherapy in lung cancer, and it hasn't been successful. As we can see, this stock having a pretty bad run, down around a third over 3 years. They've had a couple of disappointments on these kind of trials. More negativity today. We're seeing moves lower on Tradegate. Keep an eye on Roche over in Zurich this morning.
All right, equities reporter there, Joe Easton, walking us through some of the stocks to watch. And as he was speaking, some headlines crossing the Bloomberg terminal there around some consolidation, or potential consolidation, I should say. AXA and BNP Paribas saying to explore an asset management tie-up. This is, of course, just early deliberations, according to people familiar with the matter. AXA also considering other options for their asset management unit. But if you do see this tie-up, Guy, it would result to an assets under management of 1.4 trillion euros. That's a pretty big number.
Two things to read off this. One of which is this is an all-French tie-up, which I think is significant as well. You were talking earlier to Peter Pratt about the cross-border deals. This is not one of those, which I think is hugely important. The second one is scale matters.
Yeah.
You see that increasingly around the world. Look at the giant that UBS has now become.
Yeah.
And you need to compete with that now. So if you can figure out a way of tying up various different asset divisions within a country, maybe that's an easy first step. And maybe this is what this is looking at.
And again, early deliberations. We'll see if they're still saying they're looking at other options as well. But this is something that, to your point, we've seen in the past as well, specifically around Amundi, for example. They've also been looking at a lot of these acquisitions, to your point, to increase some of that scale.
Scale is super important. You're seeing it in London. You're seeing it everywhere at the moment. Scale is super important. You're seeing it in the States as well. The States, to a certain extent, has already been through that process in a way that Europe is now going through. Anyway, the market open is coming up next. It is going to be a quiet session today. The United States is closed. It is the 4th of July, as a result of which we are going to see light volumes. But there's some single stocks that I think are probably worth focusing on as well. We'll do that in just a moment. The market is about to open. The opening trade is almost upon us. This is Bloomberg. Thursday, the 4th of July, 2 minutes to go until the opening trade here in Europe. It's going to be a quiet session. The United States is out. You note the date. It is the 4th of July, a holiday in the United States. We did get a session yesterday, though, that will have an impact on us today. But maybe not actually that much of an impact. As you can see, this is the European session. We come up, we basically then get into a fairly tight range. The US opens, comes up into that kind of story as well. So not really that much happening. Remember, it was a shortened session as well for many assets in the States yesterday. So I'm not sure there's that much of a read across out of the United States. But I think the story today is going to be of light volumes, Critty. Yeah, futures are going to tick a little bit higher. What are they telling us?
Well, I think you called it. It's almost as if you checked the screen. They are indeed higher. We were looking at Eurostoxx 50 futures, FTSE 100 as well, higher by about, we'll call it 0.3% if you want to look at the rounding. But I think what's notable here is the outperformance in the French index. When you look at the future story, higher by 0.5%. What does that tell you about not just the light liquidity, light volume story, but also what that tells you in terms of perhaps some sentiment around a gridlock expectation going into, of course, the French elections this weekend as well. There's a couple of individual movers we have our eyes on in terms of how they open when we go into that opening trade. We, of course, just hit the headlines around AXA and BNP Paribas. This consolidation story you're seeing where asset management firms, consolidation specifically in two French companies that would bring assets under management of roughly 1.4 trillion euros. It also helps influence some of the management fees that you can start to see from some of these other players. You're seeing some of the read-through potentially from the U.S. as well. We've got our eyes on Lufthansa, Continental as well, and what the China read-through is into some of these companies. Guy, those are going to be just some of the conversations we're happening when it comes to the opening trade and specifically what those French indexes look like ahead of tomorrow.
OK, here we go. Time for the opening trade. As Critty says, it is upon us. Europe is now open. It is going to be a light volume session. The function on your Bloomberg that you want to use today is AVAT, AVAT. That's going to tell you average volume at time. And I suspect the chart's going to look a little light this morning. So European markets, as Critty suggested, are opening in positive territory. There you go. There's the Stoxx 600 up, but not by much. I think a lot of people are going to be sitting on their hands. But remember as well that we do have big data coming out of the United States tomorrow. Do you need to position for that? How many people are going to be at their trading desks tomorrow in the United States? We're going to see probably another low volume session, but that might increase the volatility. That might maybe produce a little bit more excitement when it comes to the session that is coming up. Anyway, Europe is open. I just want to double check. Yep, we are seeing the IBEX moving lower. I see it tick a little bit lower, confirming that it is open. At least I had to check that one. Anyway, so broadly, I would say a wait-and-see mode being established firmly here in Europe. Critty, what else are we watching?
Well, I'm going to go straight to what we're going to see in terms of the French markets, because that's where you saw the most outperformance coming into the future story. And it's really a story of heavyweights. We were talking about those headlines crossing from BNP and AXA as well. BNP now higher by 1%, contributing to the index upside, not just in the French index, but you're also seeing it show up in the stock 600 as well. This really feels like banking seems to be in the front seat, alongside a little bit of SAP as well, ASML. You've got a tech trade and a bank trade, which are typically guide the opposites when you talk about that cyclical versus defensive. But today, both rallying, both moving the index a little bit higher.
I think it's an interesting story. I think it's going to be interesting to see how this one plays through. It feels like today we are waiting. I think tomorrow's going to be a day of waiting as well. Tomorrow, we're going to get a lot of US news tomorrow. We've got a lot of data coming out. We've got the ABC interview that I know you're really excited to watch. We're going to be very much focused on what comes out of that. Could that be the moment?
Me and the whole world, I think. Are you not going to be staying up late and watching it?
Of course I am.
Of course you are.
Yeah, we'll look for the headlines a little bit later. But then you position around the payroll number. You've got to factor that into your thinking as well. You've got to think about what that's going to mean ultimately and how quickly that trade could fade. And then you've got to position for the French election as well. So there's a lot to do, potentially, in a reasonably kind of light volume kind of a session. Let's talk a little bit about kind of how you position for all of this, how you should think differently about the politics on both sides of the Atlantic, how you should think maybe differently about the deficits on both sides of the Atlantic. Everybody's kind of looking at this deficit story, trying to figure out, does Trump spend more? Is he inflationary? Then they're looking at what's happening with European politics. Is it inflationary? Do they spend more? Should you be treating those two narratives in exactly the same way? Well, I think that's one of the conversations we had a little bit earlier on with Nancy Curtin. She saw things maybe differently across the Atlantic.
In France, let's call it fiscal populism. They're both talking about spending money, but they're spending money on things that I don't think really add to the productive capacity of the economy. That's very, very different. The Inflation Reduction Act and the CHIPS Act, which are actually investment in infrastructure.
Yeah.
That adds to the competitiveness of the United States. It's investment spending. That's very different than spending on pensions.
Let's talk to Mark Downing, CIO for Fixed Income at RBC BlueBay. Joins us around the table this morning. Nice to see you.
Good morning. Good to be here.
Yeah, great to see you. Let's separate it out a little bit, actually. Let's focus on France, first of all, and figure out what is happening there. What do you think the trade is through this weekend? What do you think the market is expecting on Monday morning? Is there a kind of short-term reaction and then a longer-term reaction that we need to think about?
Yeah, so after the election was called and took everyone by surprise, obviously the initial move was wider in French spreads as we priced a premium into French assets, into European assets. But after last weekend's results, as it's become clearer, particularly with a lot of third-party candidates dropping out, the National Rally now looks very unlikely to get the majority that maybe investors have been fearing at one point last week. Now that's come more into view. I think at the moment what we're seeing this week is a bit of a short covering trade. Effectively, people were taking off hedges. Yep. We're seeing a bit of a rally back in spreads. That's been the direction of travel this week, and we may see that carry on into the start of next week. But thereafter, I think it becomes interesting. Thereafter, I do think that the genie is out of the bottle now on French politics. Investors are going to be looking to 2027, right? It doesn't look good.
The genie's out of the bottle a little as well when it comes to the French economy, don't you think, too? Everybody kind of not many people were really focusing on the debt dynamics around France in a big way. They now are focusing on those debt dynamics. And I keep hearing people talking about the idea that maybe actually OATs and BTPs are kind of in the same bag right now. Do you think they are?
Well, I would say that on the fiscal side, it's always been a pretty poor story, but people have been happy to turn a blind eye.
Exactly.
Now that we have the EU sort of putting France into excessive deficit procedure, as it's long been overdue in many respects, I think that we're seeing more attention coming on France, and particularly for investors, I think, outside of Europe, I think they're waking up to the fact that there's now a bit more risk in terms of owning French assets. And I think the problem here is that although France is starting from a very strong starting position, the trajectory of travel here is not a good one, right? So if you follow the policies that are currently being pursued, at some point in the future, France is going into the direction of Italy. Certainly today, I'd actually contend that France is an inferior credit to Spain, for example. So we are seeing that sort of relative move. So you're not at Italy levels yet. You won't be for a while. But certainly at the moment, it's ironic to think that within the G7 almost, Italy is the haven of political stability, isn't it?
You're making Critty very happy.
I was going to say, somewhere Enrique Iglesias is smiling on the comment. There's a lot of talk about...
he follows the bond market on a regular basis.
He's hooked. His next song is going to be about it. It's going to be an ode to Mark Downing. There's a lot of questions right now about what it would take for ECB intervention if we do start to see some sort of panic, some sort of Liz Truss moment in French debt. We talked to Peter Praet about that very concept. What is the line in the sand where the ECB may need to intervene?
Well, frankly, it's miles away, right? So if you look at this from an Italian perspective, I think there's always been some sensitivity, some thinking that if you saw the BTP spread up at around 300 basis points, you actually start to reach a level at which you start to question fiscal debt sustainability, and therefore you end up in a very unstable equilibrium. So as spreads breach that sort of level, either they've got to retrace tighter, otherwise you're into something of a death spiral. And that's where the ECB has got policies in place to effectively to intervene to make sure that you end up with an orderly market and you don't enter into that sort of situation. But it would be completely inappropriate for the ECB to be intervening to help out France if France is pursuing sort of policies that are going against the EU framework in terms of the fiscal deficit, particularly intervening to help France when the spreads in France are a long way tighter than they are in Italy. I think the only thing that could be a catalyst is if you did end up with OATs trading out to, say, 150, and that was actually a catalyst for Italian assets to move back to 250 in terms of a spread scenario. I mean, this is a more of an extreme scenario. In that case, I think there would be a mandate to say that this isn't Italy's fault. Poor old Italy is sort of feeling the pain that's coming from its northern border. And in that case, I'm sure Giorgia Meloni would be putting a call in to Madame Lagarde and seeing if she can get a bit of help out of her French friend. Do
you think there's a direct line there between Giorgia Meloni and Christine Lagarde?
Yeah. Well, it depends what job Christine Lagarde is doing at that point.
That's a complicated question. I'm going to change it. To what extent is what we see in France in terms of the way this trade functions in terms of dealing with the deficit? So you're selling the long end. How much of that is a roadmap for the deficit concerns in the States?
Well, I think it's there's many aspects of this which are a similar story. I think that globally, not just in France, we're seeing politics shift to support for the extreme right parties. It's a global phenomena. And you could say it's an echo of what we're seeing in Donald Trump. The other thing that I'd also say sort of very clearly, in the US, what really strikes me when I'm in DC on both sides of the aisle in Congress is that everywhere I go, policymakers are saying there's nothing to worry about in terms of the deficit. Stop talking to us like you're a bond vigilante. The fact that the yield curve is inverted actually means we can borrow long-dated money more cheaply than short-dated money. Therefore, there can't be anything to worry about.
How do you trade it, Mark?
Well, I think the truth is you've got to look for a curve steepener over time. I would say that, I mean, I guess I grew up learning that an inverted yield curve is an abnormality. It's not something that's meant to last for a long period of time. It's something that is normally temporary just before.
Okay, so how does the curve steepen?
So the curve will steepen in one of two ways. Either we're going to see weak economic data, and on that basis you'll end up with the front end rallying as the Fed cuts, or you end up in a situation where the back end sells off on fiscal concerns. Because here, it's almost like you've got a fault line underneath the bond market. We don't know when it's going to shift. We don't know when the deficit and the debt levels are going to be a problem. But there could be something that actually acts as a catalyst. It doesn't matter up until the day it does. And it could be a quarterly refunding announcement, for example.
OK. he's kind of hedging his bets here.
I was going to say, are you going to tell us how your position?
I'm going for a steepener.
So you're going for the steepener, but which type of steepener? Which do you think is more likely?
I would say at the moment I don't have a strong directional view on US rates. Earlier in the year, it was an obvious view directional on rates. Rates were going to move higher. We had loads of banks predicting either a rate cut in March or June. It was bananas. You'd go to the economy and you could tell.
So you haven't put this trade on yet?
So we're in the steepener, but in the steepener. So buying to selling 30s we think is the right trade to have on right now in terms of treasuries. Otherwise, the big directional view we've got, obviously, is in Japan, where I continue to hate JGBs.
But love the stock market still?
Still like the stock market. It's a reflation trade, right? I mean, Japan is going through a period of reflation, and I think that we're going to see policy shift. And the one thing I have wondered, on a very, very quiet July 4th... I wonder if the guys in Tokyo at the Ministry of Finance are eyeing up some thin market liquidity and might want to have a go at the yen this afternoon, you know? I mean, they've got form for it in the course of the last couple of weeks. So this was one sort of cheeky little thought for the day. I just wonder whether there is any cause to actually keep your eye on the yen.
But in that theme of cashing out for the deficit, for example, how sustainable is that kind of intervention, even if you do get it today?
Well, I think that ultimately intervention, we know it only works if it's joined up policy. You kind of need to see the Bank of Japan sort of really sort of coming to the table and actually moving on interest rates as well as delivering a move towards quantitative tightening. I happen to think that a July BOJ move is underpriced. I think that there is a good chance that in addition to the reduction in the RIM band from 6 trillion to 4 trillion, I think that they probably also might be looking at doing rates to 25 basis points, so a 15 basis point hike. So that would be interesting. But otherwise, for the time being, I think they're just trying to stop it sliding even worse. I mean, the yen has been sliding at a rate here, and I think the Ministry of Finance are just desperate to stem the flow and put a bit more risk into the situation. And so let's see.
Got payrolls tomorrow, though. Got payrolls tomorrow. Got payrolls on Friday. Tomorrow is Friday.
It is tomorrow, yeah.
You got it.
I've lost the end of the week. I have no idea what's going on.
We're all in holiday mode, right? But I think that in a way, when it comes to payrolls, it's likely to be a softer number. We've seen claims going softer.
Yeah.
Mark, great pleasure. Thanks for talking.
Thank you very much.
On this, it doesn't quite feel like a holiday. The sun is shining, but it doesn't quite feel like a holiday. Maybe it should. Mark Dowding, the CIO for fixed income at RBC BlueBay. Core 6 looks like this today. To be honest, stock markets are rather becalmed, and that's the picture you're certainly seeing in the Core 6.
All right. Well, I guess something more interesting than the Core 6 will be what Joe Easton has for us. Joe, walk us through some of the individual market moves.
So one area, Critty, we are seeing a decent move is over in the auto space. Continental rising the most in 2 years, on track for the biggest gain in 4 years after a pre-close call with investors and analysts last night. The company saying that the China business is making up for some of the weakness in European tyres and also, more importantly, the automotive business. So this is brakes and other components for cars away from tyres is really rebounding at the moment. So that stock up almost 10% over in Germany today, and we're seeing a feed through into Pirelli, Michelin and Valeo in France as well. Those stocks getting a boost at the moment. Then there's lots going on in the healthcare space today as well. This morning we mentioned Roche halting that lung cancer drug trial earlier today. That was in a statement. Bit of a shock for the market there, coming down 2% on that one. Meanwhile, in London, Smith & Nephew, the best performer after Cevian, the activist investor over in Sweden, announced a stake in the company. About 5% they're buying in. We'll see what they do in terms of speaking to management on that company. That is in the medical devices space there. Redcar Pharmacy over in Germany, online pharmaceuticals getting a boost after its sales. That one rising at 9%, another big mover today. One Stop dropping a lot, though. This is Norwegian Air. It's a profit warning out of them this morning, down almost 16% today. That's the biggest decline since 2021. Warning and a number of issues, declining passenger passenger numbers, also fuel prices and wages, and also the impact of currency movements with the weakness in the Norwegian krone as well. So that's hitting that one. Seeing a very small read across into the likes of Ryanair, EasyJet and Wizz. Keep an eye on the airlines today. We'll have a look at Ericsson, another impairment on that Vonage business, the communication services company. That's coming down 1.3%. Investors not too keen on that one at the moment. And I'll just check in on some UK domestic stocks. Voters heading to the polls, so I'll be keeping an eye on home builders, banks, utilities, and also a couple of the M&A situations, including Royal Mail owner IDS. That's more of a story for tomorrow, though. Finally, we will bring you one morning call. This one caught my eye. It is Pandora. We're over in Denmark today. Gets a street low price target over at RBC. RBC says the rising silver price will push up the cost for Pandora, making those charm bracelets all the more expensive to make. That one's coming down 2%. RBC underweight Pandora this morning.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of those early movers in the U.S. trading session. European trading session, force the habit. I want to come back to one of the banking stories that just crossed the wire. Some potential consolidation news, emphasis on potential between AXA and BNP. You're seeing both trading higher this morning. Let's get a few more details here. Bloomberg's managing editor for finance and investing in EMEA, Tom Metcalf, joins us around the table. Okay, so this isn't official yet. We've got the deliberation still. Walk us through the perks of this deal if it does go through.
Well, yeah, it's a hunt for scale, right? So right now they're about 800 billion, 500 billion or so for AXA and BNP respectively. So together you'd have a 1.4 trillion euro asset manager. And really that's kind of what the whole industry is effectively chasing after right now. You know, you get better management fees, you have the extra bulk. And really, that's kind of a trend that over the last few years, you know, we've seen a lot of people looking for consolidation. We've seen a lot of chatter. As you say, this is a pretty early stage, so you never quite know where these things go through. But it makes a lot of sort of strategic sense and certainly would be a big deal for French finance.
OK, French finance, it's a French deal. We're still at that kind of level, aren't we? We're still trying to do intra-country deal rather than intra-European deals, which I think is interesting. Is therefore that deal easier to get done? If this is a kind of Paris transaction, does it increase the likelihood of it actually happening?
Yeah, I think absolutely. These two firms know each other pretty well. Yeah. They've had various partnerships. You know, their offices are not even that far away from each other in Paris. So no, I think that's the other appeal of this, and why it does make sense is, you know, you're looking probably for a partner within your country, and then of course, you know, that sort of that accretion of scale is even more powerful because you're, you know, effectively knocking out a direct competitor in your own domestic market.
Are there other potential suitors for AXA right now?
I think there'll be plenty of interest in this. So we understand, you know, this is one of various sort of options they're looking at, various kind of bidders that might be in the mix. So it'll be interesting how it pans out. But as we're just saying, I think if it's going to go to anyone or this partnership will happen, it probably would happen between two French businesses.
How big do you need to get? 1.4 trillion. Is that enough? Do they need to do more than that? How does that stack up with others? Give us a kind of context story here.
Well, in Europe, it would be one of the biggest. Yeah. But then, you know, let's go, you know, look at a BlackRock or something, which, you know, many multiples of that. So I think it's definitely going to be substantive enough for Europe. But in terms of globally, I think they probably are amazingly still be seen as quite subscale, even with 1.4 trillion. So, you know, I think it's just a constant. We'll see a lot more consolidation. Certainly anything which is, you know, of the size AXA is, Aberdeen, for example, here in the UK, they're always definitely kind of on the lookout for, you know, options to grow somehow.
Tom, thank you very much indeed for updating us. Tom Metcalf, our managing editor for finance and investing here in Europe. What are we going to talk about next? We need to bring you our interview. The Ukrainian President Volodymyr Zelensky speaking exclusively to Bloomberg. We talked to him about the Trump presidency. Anne-Marie asked him about this and what it could mean for the war. We'll talk more about that. Plus, we're going to focus as well on what is happening in the United States, the political story developing fast and furious around Joe Biden's candidacy for a second term. We'll talk about that as well. This is Bloomberg.
So let us imagine that the winner might be Trump in November. And he knows how to end the war. He has a plan. Me, as the president of a country at war, not a theoretical person, a real-life person, I would like to be prepared. We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? Tomorrow, do we want the war to be over tomorrow? We didn't the war even to start. It was Putin who started it. But I hope you agree that it would be fair. If Trump knows how to end this war, he should tell us today, because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone.
Ukrainian President Vladimir Zelensky, they're speaking exclusively to Bloomberg's Amory Hordern, Guy, about kind of Trump-proofing or what that future might actually look like. This is in line with the Trump-proofing story we're hearing out of NATO, we're hearing out of tariff policy in the EU, out of defense manufacturing. What does that 2.0 actually look like?
That's the problem. And to the President of Ukraine's point, it would be nice to get more information. Trump has given us some hints, some ideas about what he might do were he to get back into the White House, back into the Oval Office. But Zelensky clearly wants details. Others clearly want detail as well. I think the sense from the markets and from European politicians is you just got to prepare. You've got to get ready. You've got to understand kind of how you would face this. I think there was a sense last time around that Europe was desperately underprepared. It doesn't want to make the same mistake again.
But I think what gets tricky is that you can't use the playbook of 2016 or even 2020 this time around because it's so different. Some of the tariffs that he's talking about are already still in place. The margin of movement, the economic resilience, the COVID story. There's so much else going on, and that's just one side of the equation. Then we've got to talk about a potential Biden 2.0 or a potential someone else 2.0, depending on what happens with the Democratic ticket.
Someone else being?
You can say it.
Well, Kamala Harris is the vice president, is being perceived at the moment as the front runner. And you can understand the reasons why that might be a clearer route. I think it is. We're talking about replacing Joe Biden as if it's something that is straightforward to do. I don't think it is. The Biden-Harris ticket has this pool of money which Harris can access in a way that potentially others can't. Also, are the Democrats really prepared to step over their first woman candidate, female candidates? Are they really prepared to do that at this point in time? I don't know. I think there's a number of different things at play here. It's going to be an interesting weekend.
There's going to be an interesting weekend. I think for our global audience, we need to make it clear that President Biden already legally has a lot of swing states that are then wrapped up specifically in his electoral ballot. So he has to physically say, I'm stepping down for Kamala Harris to then take the reins. You also have to get the likes of Gavin Newsom, et cetera. But Kamala Harris, to your point, is leader. You should also keep in mind that the next key pieces is this taped interview that is going to be airing Friday night. And then it's, of course, going to be what happens with the DNC as well in July 11th. They're having these conversations. Polling matters. Biggest Trump lead ever by about 7 to 8 points right now in the latest polls.
Yep, it's going to be an interesting weekend. We're going to watch those polls very carefully over the weekend. We're also going to be watching what is happening with the French election. That takes place as well. The second round is coming up. How should stock investors be kind of preparing for this? Emmanuel Cao, head of European equity strategy at Barclays, is going to be joining us next. The polls are open in the UK. The polls are open in North London. This is a live shot from Islington. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. You are seeing green across the screen broadly, but some outperformance in the French index. Interesting higher by about 0.7%, despite the fact that there is that geopolitical risk overhang. I'm going to also get a quick check on euro dollar as well. Guy, 107.92. Strength seems to be the picture of Europe today.
Today's kind of a weird session, though, isn't it? You've got the US out. You are going to take some volume out of the market as a result of that. Maybe you see, therefore, a little bit more volatility. But the trade over the last few days has definitely been to price out some of the risk in France, which has been positive for euro dollar. You've seen it in French assets as well in a little bit more detail. So let's talk more about what is happening in France. Far right leader Marine Le Pen not sounding happy last night, lashing out on TV, basically against Emmanuel Macron, against a load of people, actually. Macron centrist group, the left-wing alliance, basically these two rivals weirdly kind of in some ways joining forces to block her National Rally Party from gaining an absolute majority in the second and final round of the French parliamentary elections. Phil Serafino joins us out of Paris, Bloomberg's senior editor in the French capital. Phil, she's not happy. What kind of an impact do you think these two-way races versus the three-way races we originally had out of the first round are going to have? How difficult is the absolute majority now looking?
Yeah, it really makes it much more difficult for her. The math is not very forgiving. She needs 289 seats to get a majority. The left and the center have decided that the worst possible outcome would be a government led by the National Rally. So they've sort of pulled together and decided to pull candidates out of some of those races. We have a poll that we're reporting today that shows she might get 190 to 220 seats. That would be well short of a majority. So this tactic is looking pretty effective, and that's why she's not happy about it.
Phil, is the best case scenario for markets gridlock?
That seems to be what the markets are saying. We have Morgan Stanley out with a report today saying it's time to buy French stocks. The worst case from the market's perspective would have been if the left had won. Investors say it would have been like a tax and spend government, which they were not excited about. Lots of regulation. The second worst outcome would be a national rally government, according to investors. But gridlock, maybe things don't get worse in France's fiscal situation. It'll be very difficult to do any sort of radical regulation or policy changes. And so investors are sort of coming to terms with that. And that's one of the reasons you see the French stock market up today.
All right, Phil Serafino, Bloomberg senior editor in Paris, monitoring both the markets and the politics for us. We thank you so much. Let's get a little bit more insight here. Emmanuel Cao joins us this morning, head of European equity strategy at Barclays. A pleasure to have you on our new desk, by the way. I hope you're sitting comfortable. I'm going to pose the same question to you that I just posed to Phil. Is the best case scenario for markets gridlock?
Well, I think the less bad scenario is probably the gridlock, right? So I think what the market was very worried about is the tail risk of either a far-right majority or far-left majority. I think based on the result on the first round we got on Sunday night, those two scenarios looks the least likely as it stands. So either you have a hung parliament, which means gridlock, as you said, or still the possibility of a minority, a majority for the RN party, and they could actually be in a position to set up a minority government. So I think there are a lot of outcomes which can still, surprise the market on Sunday night. But the most likely one, according to our view, is that you get a hung parliament. So no one has a strong majority. Nothing really bad is going to happen, but nothing really good either. And you have to think about more persistent political uncertainty. Macron still has 3 years to go until the end of his second term. Yeah. And you probably have to expect a lot of headlines and wobbles over the next 3 years.
So we're seeing green on the screen right now for the French index in particular, but going back to, I've just got a chart pulled up on my own screen here, back to early May, you saw the 10% drop in the index. On Monday, on Tuesday, after we get these results, is that a buying opportunity? When do we pair that loss?
There was a lot of indiscriminate selling after Macron called the elections 3 weeks ago. You have seen quite a fair amount of de-risking on the French equity market, and to some extent, in the last couple of days, the French equity market has lagged the improvement in OAT spreads and in euro-dollar. So I suspect the relief in the short term will, prompt deep buyers to step in. We've seen a lot of things like banks, like utilities, like, rate-sensitive sectors doing quite badly without a fundamental reason for that. So, I think if you exclude the tail risk of very indisciplined fiscal policy, spread should tighten a bit, and that should help the equity market to bounce. Now, beyond that, as I said, I think it's fair to believe that the risk premium on French assets will stay higher than it used to be, simply because the market has to price a fairly high degree of uncertainty. What kind of government are we going to get? Can we get an EU-friendly budget in September? And again, what is the outlook for the French political, outlook? Are we going to have an election in a year's time? It is a possibility. Do you have a very unstable political environment for the next 3 years? That's something which I think might keep market on edge.
If I'm not buying French stocks, or I think French stocks are going to trade at a discount for a while longer, Do I buy other European stocks? What's the portfolio effect of that?
Look, we think that things which have gone down in sympathy with France, like Italy, for example, are maybe a more straightforward buying opportunity. As it stands, what we are seeing in France is still a very much a local issue, more than a broader pan-European issue in our view. We don't think this is putting into question, European integration, peripheral stress, etc. So I do think that things like, Italian banks, some of the rate-sensitive names in Italy, which went down, again, in sympathy with the widening 0.80 spread, will be good buying opportunities. We also think that some of the exporters that do benefit from a softer euro down the road should benefit as well. So, to be clear, we like some of the French stocks. We like the banks, we like the utilities, but I suspect the market will keep worrying about more persistent instability. Other parts of the market, like UK as well, can be interesting in the pan-European context.
You still got your 540 target on the Stoxx 600?
Yeah, absolutely.
Is that more vulnerable now? What gets us? We're trading this morning 516. What gets us to 540?
I think it is obviously about the growth policy environment. I think politics are mostly noise. We have to, deal with that on a day-to-day basis. But to us, it's very much about the ability of central banks to keep cutting rate, to support the economy, because inflation is going down to target, right? So we think growth is actually okay in Europe. It's not amazing, but it's holding up, it's stabilizing, it's bottoming out. And central banks are in a position to provide extra support to the economy by cutting rate preemptively, right? So this is the case to get a higher equity market down the road. But firstly, a lot of this Goldilocks environment is priced in. The market is up 10% on the year. So, some of this story is already in the price. And secondly, you have more tail risk. You have political tail risk in Europe. You also have the uncertainty in the US, with the election coming
So it's getting
soon.
harder to get to 540.
Look, I think the market has to be, looking for hedges because, again, things have gone up quite a lot. You have tail risk, and I think the asymmetry is getting a bit more tilt to the downside after a big run for the market.
Is that leading to some sort of capital flight story? If we have that tail risk, or if we even have even risk out of the States as well, is there a capital flow story that outweighs some of the fundamentals?
Well, I think if you look at a typical market seasonality, it's usually a bit more volatile, negative in the summer, right? So I suspect for the very short term, you can think about French election being a bit of a relief to the market. You can think about Q2 earnings, being a support. We expect earnings to be pretty good for Q2. But once those things have played out, I think you end up with maybe a bit of a air pocket for the market in August, September, the classic late summer seasonality, just when the election uncertainty kicks in as well in the US. So if you look at a typical playbook, you should be a bit more cautious into the November election and then buy the dip, assuming there's a dip to buy for the year-end rally.
So you want to hedge the risk? The tail risks are growing. How do you do that, I guess, is the key question. In some ways, the way that a lot of people have hedged European risk is just to buy the States.
But there's also the European trade in there. The flip side of the argument is that so many of the companies that are listed here, something like 60-70% of their revenue comes from the States. So it's also a catch-up trade into Europe. Emmanuel, how do you think about that exposure to the American consumer that so many European companies have?
I think you have different things to take into account, right? Firstly, you have a fairly strong U.S. economy, which has benefited European exporters. What we just talked about, the French election uncertainty, should put a cap on the euro-dollar in our view. So that should still benefit the European exporter. Now, if you put that in the context of the US election, you have to think about tariff. You have to think about what Trump policies might do to some part of the European equity market. And here, obviously, you have some potential losers if you have more trade barriers, etc. So I think it's going to be
potential losers. Which ones?
Well, I think some of the names in industrials, in consumers, which could be exposed to tariff, is what you have to think about. We're pretty cautious on the auto sector, for example, which you could be vulnerable to tariff or trade restrictions. And you have to think about the China exposure as well, because Europe is obviously very sensitive to China. And if you have more friction between the US and China, I think Europe might be stuck in the middle of this trade war and make it a bit more difficult.
So how do you hedge? You've
laid
out a lot of risks here.
It's very doomsday this
there are
morning.
always risks. I think there are always many risks. What I'm saying, the market is already at a very high level. A lot of good news are priced in. Volatility is very cheap. So number one, buy volatility. Number two, diversify your portfolio. We have done more
barbell. Means I'm going to underperform, right?
No, diversify is about not putting your eggs in the same basket. And we have been reducing our beta in the portfolio. Firstly, we want to be more exposed to the part of the market that would benefit from lower interest rate. We think the story for the second half of the year is is Fed cutting rate, BOE cutting rate, ECB cutting rate, and we think the sector that would benefit from that should be increasing portfolio, which is also a way to get a bit more balance and defensiveness.
Isn't that just buying tech? And isn't that just buying U.S. tech, what you just outlined there, the interest rate sensitivity and defensive and everything you just said?
Yeah, but I think that's what people have been doing for the past 2 years. I think there are ways to have, other way to diversify without just being overly exposed to what is available. So we like tech in the US very much, but because we like tech very much and everybody likes US tech very much, we want to have non-tech exposure.
Isn't the way to play lower rates to buy the bond market? I know an equity guy don't want to talk about that.
I know.
we like bond proxies. We like, we added back to utilities, real estate. So we think some of the bond proxies that would benefit from more stable or lower interest rates should be added in portfolio.
But there's an argument that if you're talking about a bond proxy, you traditionally think utilities, et cetera, for that. There's an argument that U.S. tech is the bond proxy because the U.S. tech companies can borrow at very close rates to the U.S. Treasury.
This is really interesting. So this is the good news, bad news story as well, which is that in some ways, the market at the moment is looking at the data and saying bad news is good news for the equity market. But then you think about what the equity market is buying, which is big tech, which in some ways is a safe haven trade. So I'm kind of wondering how that whole narrative works and whether or not people are hiding out in tech because they're worried about everything else.
So I think, what we need to see for people to move away from tech and think about broadening is more confirmation of the Fed ability to cut rate. And we spend a lot of time talking about election and all this stuff, but I think what matters for the market is whether the Fed can indeed start cutting rate in the second half of the year and start to ease those concerns of a hardening of a policy mistake. If market is much more comfortable with Fed cutting rate, extending the cycle, you're going to see, I think, a broadening of the rally to non-tech part of the market.
Manuel, great to see you. Thanks for stopping by to see us around the table. Really appreciate it. Manuel Cao, Head of European Equity Strategy, joining us from Barclays. Coming up, you don't want to miss our conversation with Roxane Varza. She is the Station F director. It's a startup campus in Paris. It was set up by Emmanuel Macron. Now what? What happens with the European tech scene? What happens with this business-friendly strategy that Macron has pushed? We'll talk about that next. This is Bloomberg.
What the Macron government has done in the recent years has been quite business friendly, and you see results in terms of the development of Paris as a stock market place, investment place. You see that very much as a result of that sort of policy. Now the potential reversal of that sort of policy would be very damaging. And so you cannot blame the lack of capital market union. I think governments themselves should look, why is savings, flowing to the United States and other countries and not staying in Europe?
Peter Prett, former ECB chief economist, talking to Critty and I a little bit earlier on in this hour, talking about this really positive business environment that Emmanuel Macron, the French president, has tried to foster in his country. We've seen various big conferences. We've seen him really pushing the startup story. We've seen him trying to attract high-tech business into France. Does that, as Peter Prett suggests, maybe now go into reverse? And what is the implication of that? Well, we've got the perfect person to talk to about that. Roxane Varza, director of Station F. This is the world's biggest startup campus, created by Emmanuel Macron, designed to do exactly what I was just discussing. Roxane, great to see you on the programme. If we see this process going into reverse, if we see this more business-friendly approach that Emmanuel Macron has driven starting to go into reverse, what does it mean for Station F? What does it mean for startups in France?
Yes, well, let me first clarify by saying that Station F is actually a private campus, so it's not a government initiative. But I actually think that a lot of what has happened since Emmanuel Macron has taken the presidency in 2017 has been incredibly positive. And I think there's a lot of fear from the ecosystem. We're hearing on the right things that would heavily impact all of the positive immigration that we have seen. We have 65 nationalities at Station F, building companies, contributing to great international businesses there. And on the left, we're hearing some taxation measures that sound like pre-Macron era. But I think that we're more likely to be headed to a hung parliament situation, which would mean that hopefully a lot of these more extreme measures that we're hearing about would actually be somewhat mitigated.
Yeah. So you think that France remains a good place to do business with a hung parliament?
I think hopefully we're hoping that it will not go backwards. The sad part is that we will probably not be going as forward as we would have been had this not been the situation. We have made tremendous progress the last 7 years. And so I think right now there's a lot of fear and we're looking at very extreme situations, but I think hopefully we will end up somewhere less extreme than what has been projected.
Roxanne, you have a background in Silicon Valley. You know better than anyone that startups, especially in the tech space, so many of them have an ultimate fundraising goal of hitting the IPO markets, of going public at some point. We know Emmanuel Macron, for example, has been really trying to lead the charge of making the Paris IPO market the perhaps alternative to London. How's that going?
I think the startup ecosystem has made so much progress, whether it be early stage, late stage funding, whether it be attracting international talent and investment. I do think that the exit market is still where there is a lot of room for improvement. That can be with the IPO market, which I think is probably going to take a lot more time. Even if the political situation was perfect, it would have taken a lot more time. But I do think that mergers and acquisitions is definitely a place that the government could spend a lot more time and make a lot of difference.
So when we talk then about the fundraising, we'll keep the public markets out of it as well. What does interaction in the private market specifically look like when at a time we're talking so much about all this optimism in these private deal-making space, arguably too much optimism? How does that reflect and show up in terms of the investments in some of these startups?
Well, I think at the moment we haven't actually felt a change yet, to be honest. I think everyone's talking about it, but we're still seeing a lot of the international investors coming to Paris, still talking to companies. There's still a lot of excitement, especially around AI. So we're not actually seeing that shift yet. And I think Sunday's election will obviously be very telling and may change things. But I do think that if we continue to be able to keep what we currently have in place and we don't move backwards, we don't go back on some of the policies that were put into place by the current government, that may not actually change.
Roxanne, you're in Lisbon right now. Nice place, great custard cakes. A lot of people moving there right now to set up companies. How strong is the competition for the talent that you've managed to bring to Paris, to bring to France? How strong is the competition to move elsewhere? What does it look like in Lisbon to you? What does it look like in other parts of Europe?
I love Lisbon. I think they have a great ecosystem here. They have some very, very strong points, and there is a very international ecosystem here. But I still think that with regards to the types of companies, the types of talent, I mean, when we look at the French ecosystem, I think all the tier one international funds have started making investments there in the last year, maybe 2 years. We have companies like Mistral and more recently H Company that have been compared with OpenAI. I mean, we're talking about a very, very high level of innovation and of competition. I think there's potential for other ecosystems to step in and take that place, depending on how Sunday's election turns out and maybe the future presidential election. But I think we may not see that in the very near future.
In terms of kind of what you are going to do on Monday morning, what is your plan? What are you thinking about? Are you going to be kind of keeping everybody calm? Kind of just give me a sense of the feedback you're getting from some of the startups you're talking to right now about the sort of the level of concern that they have right now. Is this something that will play out over a long period of time? Is this something that could play out over a short period of time were the narrative to change?
To be honest, I think there's a lot more fear than what the reality will actually show us. Startups are innovators. They innovate themselves out of problems and out of difficult times. So I think there is a huge potential for that, given what the situation will be. And at the same time, I think we've already lived in France when President Hollande, pre-Macron, came to his presidency, and he announced some very drastic tax measures that encouraged a lot of high net worth individuals to want to leave. We had what we called the pigeon movement at the time. And I think the government is actually very, very cautious not to repeat that same thing. And I actually think that the far-right government is also trying to woo the business audience. So we may not have as crazy of an outcome for the startups as we may be expecting.
Well, the far right maybe, but is the European Commission? Roxanne, you mentioned competition and specifically those investments in AI. We also know the European Commission has been going very tough right now on a lot of American tech companies introducing things like the Digital Markets Act, which some people around the world are calling stifling of innovation. Are you seeing that ripple effect? Is there a fear to dive into the industry because of those regulations?
Actually, no. I think what we've started to see more recently is a lot more consciousness and almost, I mean, especially we saw it with the AI Act, the policymakers were much more present and listening to some of the concerns and some of the fears. I don't think we've reached something that's perfect, but I think that there's definitely not a huge regulatory fear, at least in the ecosystem that we're working with at Station F. These are very early stage companies. We do have a lot of the very high profile big tech corporates that are there as well, but this is not something that we're hearing.
All right, Roxanne Varza, Director of Startup Campus Station F, we thank you so much for joining us ahead of the French elections this week. Now, there's plenty else on the docket for today as well. We've got plenty coming out of the ECB. Those June meeting minutes going to be hitting the wire as well, plus some of the speakers speaking at an event in Rome. We've got that EU EV tariff deadline that does kick in today. But again, those negotiations are happening in the background. So we'll see how much actual money changes hands, plus, of course, the UK general election today, which is coinciding with U.S. markets being closed for Independence Day over in the States, showing up in light liquidity, light volume. I'm wondering if a lot of the trading actually happens tomorrow.
I think, well, trading will happen tomorrow, but how many people are actually going to show up? You give me a holiday on a Thursday, I'll try and take the Friday off. The French would say, you make the bridge, you fais le pont, into the weekend. So I suspect that a lot of people will be doing that. So maybe we are going to see like trading volume again being part of the pattern tomorrow, on a day when we're going to see payrolls and a day when we're going to see a big focus on politics as well. So the potential for volatility tomorrow, I think, is really quite significant.
I'm sure there's a lot of Americans kind of rolling their eyes that they have to be online the day after July 4th, kind of weighing off all the beer and hot dogs and still having to pay attention.
Is that what you do, beer and hot dogs?
I don't know, actually. It's a good question. I think so.
What are you going to do for the rest of today? I do wonder.
I mean, I'm going to go put my red, white, and blue on and try to convince some folks to actually, in Europe, this is part of my mission here, is to get some more people on Spain's side for the Euros tomorrow. That's my goal.
Okay.
As a European.
Big weekend coming up. Big weekend coming up with the football story. Certainly we're going to be watching that over the weekend. What else are we going to be watching here in the UK? Well, voters casting their ballots in the general election today. We're watching that very, very carefully. Remember that we're going to have a special coming up a little bit later on, 10 p.m. London time. Francine Lacqua on Bloomberg Television, and we will watch the exit poll at that point as well. Francine will be speaking exclusively a little bit later on as well with Valdis Dombrovskis. He, of course, is the European Commission Executive Vice President and EU Trade Commissioner. This is trade between Brussels, Beijing heating up. We're watching the Trump trade as well. That interview, 10:15 a.m. London time. We will leave you with a live shot of Westminster.